Alright guys, so today we're going to talk about Forex versus futures. A lot of people, when I first started trading, was trading Forex. I started off trading Forex, and about 3 years into my journey, I switched into futures because I just personally feel like they're better for my personal trading style. Today we're going to go over what the difference is and why I think everybody should trade futures over Forex, and the reasons why. I'm also going to give some benefits, well, basically some pros and cons to both of them. And basically we're just going to start with these two short little explanation videos. They're both 3 minutes each. So we're going to watch one on how, what CFDs are. We're going to watch another one on what futures are, and then I'm going to give my opinion after that. So let's go ahead and start with the video real quick.
Welcome back to the Iondo Academy. In this series, we're going to look closely at one of the most popular and innovative investment tools, contracts for difference, mostly called CFDs. CFDs allow you to trade on the price movements of any financial market, like stocks, commodities, indices, or currencies, without actually owning the underlying instrument. If you think the price of an underlying asset will go up, you can buy a CFD and benefit from that rise. This is called going long. If you think the price of an underlying asset will go down, you can sell a CFD and profit from that fall. This is called going short. The profit or loss you make is the difference between the price when you entered your position and the price when you close it.
So basically, long is buys, that's what he said so far, and shorts means sells.
Market moves in the anticipated direction, the more profit you make, but a position can also move against you, resulting in a potential loss. When you buy a CFD, you don't have to pay the full value of the position, but only a fraction, otherwise known as the margin. This practice is called trading on margin. By trading on margin, you're able, though not obligated, to purchase more than you normally would. This is known as the leverage effect.
Yeah, so trading on margin is basically leverage. That's one of the pros of trading CFD. A lot of people like that unregulated CFD brokers, which is technically not really legal for Americans, but some people, still access these brokers. But unregulated CFD brokers will give you a 1 to 500 leverage. I've even seen 1 to 1,000, but the one that I was using was given a 1 to 500 leverage. And what that means is if you put $1 in, they'll give you $500 worth of buying power. So the reason that comes in handy is because when you want to trade certain things, like let's say NASDAQ, right? Let's say I want to trade the NASDAQ on a regular CFD broker like Henko Trade, for example. They might say, okay, well, just to open one lot on NASDAQ, you need to have at least $200, sitting in your available balance just to even open the trade. Well, if you put $1 to $10 in, you obviously can't open the trade on NASDAQ because you don't have the $200 capital available, or margin, the margin required to pretty much trade that pair. Whereas if you're trading with a CFD broker and they're giving you 1 to 500 leverage, you could put $1 in. Technically, you put $1 in, but they're giving you $500 worth of buying power, so you could enter 2.5 positions on NASDAQ at that point, even with your $1, which obviously you would blow that immediately, which is another reason why CFDs are a little bit more dangerous, because the leverage makes people want to then over leverage. They give you all the rope to hang yourself in CFD, but it could also be powerful on the other end because that same leverage could be used in your favor. All right, moving forward.
The main reason why investors like to choose CFDs. For example, let's say stock ABC is trading at $10 US. You think the company's price is about to go up, so you buy 1,000 CFDs. Company ABC has a margin rate of 10%, which means you only have to deposit 10% of the total value of the trade as position margin. So, since 1,000 CFDs at $10 is $10,000 and 10% of 10,000 is 1,000, your position margin is $1,000. Now, let's say your prediction turns out to be correct and stock ABC is trading at $15 US. Your 1,000 CFDs multiplied by 15 now equal $15,000. So you made a profit of $5,000 on your position while only investing $1,000. However, keep in mind, just like you can experience higher percentage returns with a CFD if the underlying stock goes up, You can also experience higher percentage losses if the stock goes down. Here are 4 reasons why you should trade CFDs. First, you can profit in both rising and falling markets. Second, due to the leverage effect, you can use your capital very efficiently. Third, the transaction costs are very low. And fourth, CFDs are flexible instruments that allow 24-hour trading and fast execution. Those are the basics. For more trading tips, visit iondo.com.
I like that, but I'm actually gonna follow these guys because that was a great video. Hey, shout out to Trade Hero.
A $3 box of corn cereal stays at roughly the same price day to day and week to week. But corn prices can change daily, sometimes by a few cents, sometimes by a lot more. Why does the cost of processed foods generally stay quite stable, even though the crops that go into them have prices that fluctuate? It's partly thanks to the futures market. The futures market allows the people who sell and buy large quantities of corn to insulate you, the consumer, from those changes without going out of business themselves. Let's meet our corn producer, this farmer. Of course, she's always looking to sell her corn at a high price. And on the other side, our corn user, this cereal company, is always looking to buy corn at a low price. Now, the farmer has a little bit of a problem because her whole crop gets harvested at once. Lots and lots of farmers will be harvesting at the same time, and the huge supply can send the price falling.
Supply and demand.
And even though that price might be appealing to the company that makes cereal from corn, it doesn't want to purchase all of its corn at once because, among other reasons, it would have to pay to store it. But it's fortunate that corn can be stored because that means it can be sold and bought throughout the year. And this is where the futures market fits in. Buyers and sellers move bushels around in the market, though actual corn rarely changes hands. Instead of buying and selling corn, the farmer and cereal maker buy and sell contracts. Now we're getting closer to peace of mind for both sides because a futures contract provides a hedge
against the future. So basically what they're saying is the lady who's selling the corn, she wants to guarantee that she'll be able to sell her corn at this specific price in the future, regardless of what happens, whether she has less or whether any unforeseen circumstance. She wants to make sure that she can lock in this. So let's say she sells her corn for $2 a pound and the market changes in 3 months and people are selling corn for $1.50 a pound. If she had a futures contract to sell her corn for $2 a pound, well, when everybody's selling their shit for $1.50, she can still sell hers for $2 a pound. So that's why it's beneficial for people like that who are actually in the business. But for traders, it's more beneficial for us because it allows us to get exposure to these markets without actually having anything to do with it. So I can speculate and trade corn, gold, or any other commodity without having anything to actually do with that market. Whereas it was originally made for people like this just to hedge and protect their businesses, and for both sides of the market to have a contract to lock in a price.
Against a change in the price. This way, neither side is stuck with only whatever the market price is when they want to buy or sell. These contracts can be made at any time, even before the farmer plants the corn. She'll use the futures market to sell some of her anticipated crop on a certain date in the future. Of course, she's not going to sell all of her corn on that contract. Just enough corn to reassure her that a low price at harvest won't ruin her business. The contract provides that security. The cereal company uses the same market to buy bushels. Their contract protects against a high price later. Contracts will gain or lose money in the futures market. If the price goes high, the farmer loses money on that futures contract because she's stuck with it. But that's okay, because now she can sell the rest of her corn, what wasn't in that contract, at the higher price. That offsets her loss in the futures market. If, at harvest time, the price of corn is low, well, that's exactly why she entered the futures market.
And she can still sell it for the $2,
the low
like I was telling you guys.
Her contract makes money. So that profit shields her from the sting of the low price she'll get
After this,
for
I'm
the
going to show you
bushels
how
she
the
sells
difference
now.
on the chart also.
The corn cereal company doesn't like those higher prices, and that's why they have a futures contract. They make money on it and can use that profit to cover the higher price of the corn they now need to buy. The futures market serves as a risk management tool. It doesn't maximize profit. Instead, it focuses on balance. And in this way, it keeps your cereal from breaking your weekly shopping budget.
So she's talking about it from the actual perspective of the factory and the farmer and all that. But I'm showing you guys from this perspective of traders. So next thing we're going to do is go to the actual chart so I can show you the difference. All right, so this is well, let me put this back up. Okay, bow. So this is gold futures and this is gold forex, and I just wanted to show you guys the similarities. They're not the exact same, but I just wanted to show you guys the similarities. So basically, as you can see, the futures price of gold right now is at 28.48, and the forex price of gold, CFD price, is at 28.13. So that's almost like a $35 difference. And that's just showing you that right now the real spot price of gold is 28.13, but people are expecting that in the future gold will be at 28.48. You feel me? So that would be like up here. Another thing is that normally the price action is very similar, almost the same. So if you look right here, I have a 50 EMA. It's on the 5-minute chart. As you can see right here, when Forex breaks above the 50 EMA, so let me put, so you can see that it's at futures. Okay, when Forex breaks above the 50 EMA, so does futures. You see that? And then when futures breaks below the 50 EMA, so does Forex. Same right here. Break above, break down. Let's bring it to the back. Break down, break up on both, break down on both, break up on both. You see, so it's very similar, right? But then I highlighted a point back here where it didn't do the exact same thing. Why is this not? I need this to be locked. All right, bow. So I highlighted a spot back here where they weren't doing the same thing. So you see my crosshairs are supposed to line up perfectly. So let's put, okay, bow. So right here on Forex, gold made its low below the EMA right here on January 19th around 9 o'clock. But on futures, it hadn't made its lowest low yet. It didn't make this lowest low until right here at probably like the next day. You feel me? Then they began like resuming having similar price action. So I just wanted to show you guys that it's not the exact same, but it's very similar. So most times if you see someone taking a buy on gold futures, you could take a buy on gold forex, or you see someone taking a buy on gold forex, you could take a buy on gold futures, because overall the price action does move very similar. It's only those rare instances, which I think is manipulation for the most part, where they don't move the same. So that's just a quick breakdown of futures. Oh, okay, so another thing is the differences when you're actually trading forex and futures. So Forex has this thing called spread. So let's go ahead and let's go over spread. Spread in stock trading generally refers to the gap between buying and selling prices. In bonds, it indicates the yield difference between two securities. So let me show you what that actually means. Spread basically means that where you put an entry is not where your entry would actually be. So it looks like this. Spread looks like this on the chart. And it also looks like this between this black and this red line, between this red and this blue. So what this means is if I enter for a buy on Euro USD in Forex and I enter at 1.1014, my entry is actually going to show up here at 1.14. Now it's going to show up a whole 4 pips lower, and that's spread. Basically, that's how the broker keeps making some type of money, because every time you buy and sell, it's not exactly where you said it would be, and they get to keep the difference. So both futures and Forex has commissions, but in my personal opinion, I feel like futures has a lower rate of commissions, and Forex you pay more. The benefit of no spread is that when I'm trading, my stop loss might be exactly at 801. Let's say I did a trade like this on both of them, right? And let's say this red line was my stop loss, and I wanted to go here, and let's say I did the same thing let's say we had the same setup. This is futures is Forex, right? Now let's say price came down to here and then came up and hit my TP. And let's say the same thing happened on Forex. Well, on futures, I could literally be, if my stop loss is 38.4 and price comes to 38.5 or 38.6, it would not take me out. If you're on Forex or CFD and it came that low, that close to your stop loss, spread would take you out. This gap in spread, all this from where you actually enter or where your price actually is to where they say it is, the spread will hit your stop loss even if price didn't actually hit your stop loss. So that's one of the main reasons why I left Forex and came to futures, because there's been multiple times where in futures price came within literally 1 decimal point of my stop loss, did not hit it, turned around, and I ended up making like $400 or $500. So don't never underestimate, how much spread can fuck you. Spread spreads them cheeks. So watch out. We're going to keep dropping gems, keep providing value. If you like the stuff that we're talking about and you want to trade among some like-minded individuals, feel free to tap into the AE Free Sauce community. Links in the description. Leave some likes, leave some comments. Let me know. Let's get it.